Welcome to another video update from Sebold Capital Management. My name is Sean Sebold. I'm president and founder of Sebold Capital. So today in our update, we're going to talk a little bit about sales taxes with regards to selling your business. So let's get started. How do you mitigate the taxations that are going to be due when you sell your business? We're going to talk about a couple of different ways. The Grim Reaper's little brother, nothing is certain except for death and taxes. Yes, that is a very, very common saying. So to start, business sale can easily stick you into a 23.8 long-term capital gains bracket. What do I mean by that? That means that there's, so you do have some brackets with regards to capital gains. So if you make less than approximately 94,000, you're going to be in a 0% tax bracket for a capital gain. If you make more than 593-ish thousand, you're going to be in the 20% tax bracket. So where does that extra 3.8 come from? That comes from your net investment income tax. So you're going to be looking at least 23.8 from a capital gain at the federal level. It would not be uncommon to get you to a higher income tax bracket as a result. For example, state income taxes as well. So if you live in the state of Illinois, you're going to throw another 4.95% on there. So taxes are going to be a consideration. So here's a couple of paths here. We are going to talk about 4 of them today. So first, asset transfer over time. Second, a charitable remainder trust. Third, opportunity zones. And lastly, an installment sale. Okay, not my money, not my problem. So what does that mean? That means if you take some partial interest of that business and transfer it to heirs, transfer it to other people, you will mitigate some of the taxes. You can transfer tax-free gifts of up to $18,000 per year without any kind of tax issues. So that is one way that you can start to transfer some of those shares out so that when there comes a capital gain, if the business is sold, somebody else will have to pay that. It's not your problem, it will be theirs. So it's a good way to get started. It's not going to completely negate taxes because they would have to pay it if the business was ultimately sold. It's also a good method of asset protection. We spoke about that in a previous video. Second, Christmas is coming early. So we talk about in Christmas time a lot of charitable donations. So charitable remainder trusts are an effective way to do that. So you can transfer some of your those assets into a charitable remainder trust. You can get a fixed annual income for a set period of time, and you are taxed at a lower capital gains rate. So you're not getting rid of the tax, you're kind of deferring some of it. But you are going to give some economic value away. So clearly you want to be involved within the charity. That would make a lot of sense if you're going to go that route. However, once you donate to a charity or a charitable remainder trust, the asset is gone. You cannot, there's no give back, so to speak. So you can't get them back. Opportunities on both ends. So how about an opportunity zone? So these are new, and we're not sure whether, so this came in the form of the Tax Cut and Jobs Act of 2017, federally categorized locations of low income. You can invest in these. What can they do? They can defer those taxes for investments made within 180 days of a capital gain. We're not sure whether actually this is going to survive over the next year and a half, whether the Tax Cut and Jobs Act of 2017 will be renewed. But this is currently one of the mechanisms that you can use. There are some restrictions with regards to these, but it does have a good way of deferring some of those taxes for long periods of time. Now you lose the tax deferred status if you do sell those assets quickly. So this is something you have to look at from a tax perspective very, very carefully. Spread like butter, an installment sale. Let's spread the sale out over a long period of time. So if you sell a business and you're not paying all those taxes in 1 year, you say, I'm going to sell this over a long period of time. So you're going to agree with the buyer that it's going to be paid over a period of time. You'll receive an annual payment. It will have a capital gain. It'll have interest in it. The downside is, yes, the buyer is in full control of your income. If the business fails, you may not get paid back. So there are risks associated with it, but it can also save quite a bit from a tax perspective. Key points. If you don't want to be taxed, don't make money. Very simplistic. The goal is keeping yourself in a lower tax bracket upon selling of the business. When you do that, you're going to save yourself some taxes as you go forward. So thanks for listening. Really appreciate it. Look forward to seeing you in future videos.